Welcome everyone, and thank you for inviting me to this session on cyber risk. I've been researching this type of risk for more than 15 years, primarily from a computer science perspective. 2 years ago, colleagues and I have published a summary that introduces actuaries to the specifics of cyber risk at large. Today, I want to zoom into one new form of cyber risk that is increasingly watched by insurers, namely the cyber risk related to virtual assets. The term virtual assets subsumes cryptocurrencies, such as Bitcoin, and new forms of financial instruments that are held and transferred like Bitcoins, such as security tokens on the Ethereum platform, which are virtual versions of stock. Let me give you the roadmap. I will first explain some essential properties of the technology. Then I will proceed with characterizing what new cyber risks emerge in the context of virtual assets. This is relevant for insurers who want to develop policies covering virtual assets and a supporting system and services. Finally, I will close with statements with an outlook on how the insurance industry itself might change if the disintermediation enabled by virtual assets extends from online payments through security settlement, securitization, to all kinds of financial services, including insurance. In a nutshell, virtual assets are digital records that are deemed valuable because they are stored in a globally shared database which ensures scarcity. This means it is designed to ensure uniqueness of digital records. The property of information goods that they can be copied and shared indefinitely is intentionally limited to make virtual assets valuable. For the purpose of this talk, let us consider a simplified technology stack. The bottom layer is an incorruptible database. It is not very important for us to know how this is achieved technically. Bitcoin, for example, uses a decentralized peer-to-peer network along with the energy-hungry mathematical puzzles. But other designs are possible under slightly different assumptions, and this is an area of active computer science research. What matters for us is that this infrastructure ensures that a database can only be updated by appending new records, but only if these records are valid according to a set of rules hardwired into the program code. This ever-growing list of valid records represents a ledger, depicted in orange here. The ledger can take the form of a blockchain, like in Bitcoin, but other data structures are possible too. On top of the ledger sits the application. It gives meaning to the records in the ledger. For example, it can interpret tuples of asset identifiers and person identifiers as ownership. A coin with serial number 123 belongs to Alice. To make this coin scarce and thus valuable, the database must enforce two rules. First, restrict the range of serial numbers, and second, ensure that exactly one person can own every serial number at a time. This example showcases that the application of the top layer on this technology stack depends on the rules encoded in and enforced by the infrastructure at the bottom. Ownership of virtual assets is not static. Hence, most ledgers accept records that transfer ownership by updating person identifiers. However, only transfers that are authorized by the current owner must be permitted. This is achieved with the help of digital signatures and public-private key pairs. Invented in the 1970s and widely used to secure internet connections since the 1990s, these perhaps most powerful cryptographic tools have received a renaissance of attention in the recent blockchain hype. The idea is that Alice does not appear under her natural name. Rather, the ledger identifies Alice by her public key. It is her public key because only she knows the corresponding private key. With this secret, she can digitally sign an instruction to transfer ownership of her virtual asset to another person, or more precisely, to another person's public key. The recipient, the database, and everyone else can verify the correctness of the signature with Alice's public key, but it is practically infeasible to forge a signature without knowledge of the private key. Hence, only Alice can authorize transactions that move her assets. This is all we need to know to understand the basic risks of virtual assets. One may ask how relevant these technological developments are for the insurance industry. Clearly, Bitcoin was designed as a subversive technology, rejecting authority and adopted early on by cybercriminals. The ability to transfer values to accounts identified by nothing more than a public key enabled the proliferation of ransomware, which is meanwhile a standard term in cyber policies. Here is an entertaining picture I recently took on the way to work, where a public billboard was infected. Maybe the crooks should have sold the advertising space rather than extorting a ransom. But things are changing. Surveys by central banks suggest that between 1% and 2% of households hold virtual assets in some form, be it to speculate on raising exchange rates or to diversify investment portfolios. Hedge funds and family offices are said to do the latter. Derivatives on the cryptocurrency markets appear in the form of conventional securities traded on conventional exchanges. Some startups experiment with a variant of crowdfunding that involves issuing a coin or token. In particular, developments that repurpose the technology stack are worth watching. Recall that the typical crypto coin is thin air, a mere database entry without any legal implication. This can be changed with contracts and perhaps in the future by law. One conceivable example are tokenized securities, where the ledger would track ownership of a voting right and a right to a share of a venture's profit, just as conventional company stock, however, without paper. This principle could be applied to all kinds of securities in order to simplify their handling and settlement. Another example are so-called stablecoins, where the issuer of a cryptocurrency promises to buy back a coin at a fixed price, thereby stabilizing the exchange rate, which can be very volatile without any value backing. Of course, issuers of stablecoin need mechanisms to uphold this promise and to stay solvent. Not all of them have succeeded in the past. Also, Facebook's Project Libra took inspiration from this approach, but its buyback promise was not planned as an actionable legal claim. This will be very different if central banks decide to issue digital currencies themselves. Blueprints exist for both wholesale payments, where the change appears rather evolutionary, and for retail payments. The latter is revolutionary, as it could become attractive for millions of people to hold money backed by a central bank with technology that resembles Bitcoin. I hope all this illustrates that the future is possible in which virtual assets move center stage, and with it comes a new strand of cyber risk. I will use my simple technology stack here to talk about cyber risk at the user-facing side on top of the ledger before I comment on cyber risk that threatens the infrastructure and with it the integrity of the ledger itself. The key insight on the user-facing side is that virtual crypto assets, as the name suggests, use cryptography without any safety net. To illustrate this, let us recall the example of Alice owning a coin. Neither the ledger nor any other part of the system has ever identified Alice. Her identity within the system is defined by her public key only, and its security relies on the secrecy of her corresponding private key. Private keys are very long numbers and in general cannot be chosen or easily be remembered by humans. Therefore, private keys must be stored securely in personal devices where they are at risk of loss or compromise. There's no such thing as a password recovery procedure or security questions. If the key is lost, the coins are destroyed forever. Even worse, if someone else gets hold of the key, they can impersonate Alice and steal her funds. This illustrates that users managing virtual assets on their own devices, they become much more attractive targets for all kinds of cyber attacks we got to know in the context of conventional cyber risk. In fact, many strands of malware look for Bitcoin wallets and steal funds. Also, I've heard many reports of six-digit dollar amounts being stolen in social engineering attacks. To defend against these threats, security-conscious users turn to specialized products and services designed to manage private keys of virtual assets. In fact, a whole industry has formed serving this demand, and together with colleagues, we're in the process of surveying crypto asset owners on their security preferences and practices. Insurers may find this an attractive market opportunity because, say, a hardware wallet that comes with insurance coverage against theft of virtual assets has added value in a clear selling proposition. Of course, wallets would be certified to a certain upper bound for the value they can store securely, just akin physical safes. But one important difference remains. If someone breaks into a physical safe, he breaks exactly this one. However, if somebody compromises a logical system like a virtual asset wallet, he typically has found a common vulnerability and can scale the attack to many or even all instances of the same wallet. This accumulation makes the risk harder to ensure. The same logic applies to professional services that hold virtual assets on behalf of their customers. Many countries are in the process of regulating these so-called custodians or virtual asset service providers. I reckon that this industry is in dire need for insurance coverage, but to my knowledge, pricing the risk and defining the right limits and exclusions remains uncharted territory. What I've omitted here but want to mention for completeness is the emergence of additional privacy risk for end users. This aspect deserves a specialized talk. Let me now turn to new risk against infrastructure, the bottom part of the technology stack that keeps the ledger running. Clearly, every major incident here affects all assets and users on the system, hence losses are large and accumulated. The ledger can basically fail in three ways, due to vulnerabilities, rollbacks, and takeovers. Vulnerabilities are particularly harmful if they falsely accept transactions. Recall that the most important feature of the incorruptible database was to only accept records that follow the rules. For example, Bitcoin is celebrated for its fixed monetary supply to curb inflation, but an integer overflow in the C++ code would have allowed creating more than the declared upper bound of 21 million Bitcoins. This bug was fixed in August 2010 after a suspicious transaction was observed. One could argue that the Bitcoin software was not well reviewed at the time, but another book that would have allowed anyone to create new coins was introduced during a code optimization in late 2016 and stayed there for almost 2 years without being exploited. As Bitcoin software is open source and widely watched and copied, this incident reminds us again how difficult it is to spot subtle vulnerabilities. Even if bugs get discovered before they can cause losses, it is often difficult to fix the problem because decentralized systems have no party in charge of developing and rolling out patches. Colleagues and I have written a review of these kind of failures and the implications on responsible vulnerability disclosure. You can find the references on my final slide. Even without vulnerabilities, many distributed ledgers are susceptible to occasional rollbacks, also called reorganizations. Rollbacks happen when different parts of the network have temporarily inconsistent information, for example due to network latencies or the propagation of misinformation. Such inconsistencies are resolved automatically by design, but it takes some time before the data becomes incorruptible. As a result, new records do not immediately enjoy the full integrity protection. Participants may incur losses if they act too soon on ledger updates and later discover, for instance, that an incoming payment was not executed. Insurers need to understand these mechanisms very precisely to craft exclusions, prevent insurance fraud, and clarify what evidence is needed in order to support claims and losses caused by rollbacks. Finally, takeovers are risks that are primarily concern permissionless distributed ledgers. Permissionless is jargon for open to everyone. Hence, nobody has complete information about the identities of all parties who jointly run the infrastructure. The most popular virtual asset platforms, Bitcoin and Ethereum, are both permissionless. Here, a powerful adversary could undermine the infrastructure technically, with massive compute power, or economically, by bribing other participants to deviate from the protocol. While a successful adversary could in principle redefine the rules after a takeover, it is more likely that he causes strategic rollbacks or deliberately delays specific transactions of interest. There's research showing that this is happening in practice in order to facilitate front-running on Ethereum exchanges or to hold back time-critical transactions that are intended to reclaim deposits from smart contracts before a deadline. Both tactics can cause losses and, to be honest, I have no precise idea yet how insurers should deal with these risks. Perhaps broad exclusions are a solution for the first generation of virtual asset policies. Then it remains to be seen if the industry demands solutions to transfer these risks. Perhaps one could borrow ideas from alternative risk transfer instruments. There's much more to say on each of these specific forms of cyber risks, but my objective here is to give an overview. So let me use the remaining time to change the perspective and ask what could happen to insurance if it follows the path of other financial products to go virtual. Conceptually, it's quite simple. Records on the ledger could be defined to encode insurance policies, detailing the loss events covered as well as the compensation rules. Innovators have drafted many vision papers on how this kind of smart contract insurance would reduce transaction costs and increase transparency. If loss information is available through an authentic channel, which is perhaps the hardest problem in practice, then computer programs stored on the ledger could process claims predictably without intervention. Carriers who exclusively underwrite risk this way would also find it easier to signal their solvency to authorities and policyholders as the ledger details their risk exposure. Less explored, but in my opinion equally relevant, is the lens of disintermediation. Cryptocurrencies set out to disintermediate payments, hence risk transfer in insurance could be disintermediated too. For example, the rules of the ledger could allow transferring policies between carriers, restructuring and securitizing risk, and ultimately sharing it among a broader set of market participants. Needless to say that this vision faces many obstacles, ranging from the missing legal framework to competition policy, trade secrets, and the privacy of natural persons involved. Let me conclude with an observation that connects the parts of my talk and brings us back to the simple technology stack. The new cyber risks connected to virtual assets are actuarial risks. Insurers specialize in managing those risks and apply industry best practices to deal with other risks the organizations are exposed to, chiefly market risk and operational risk. If you now envision an insurance company that runs on an incorruptible database, using the same technology or perhaps the very same infrastructure as the virtual assets it underwrites, then we witness a convergence of this organization's actuarial and operational risks. Thank you for bearing with me on this tour to an imaginable future with a sizable market for virtual assets and corresponding risk transfer agreements. Let me emphasize, for those who don't know me well, that I'm in no way an enthusiast of cryptocurrency technology. All my research funding in this space was targeted at better understanding and managing of the resulting risk. Here is a list of selected results of this work. And now I'm looking forward to your questions and the discussion.